Hello, welcome back. I am your host, Charles Musgrove, and you've joined in again to the Answers That Count podcast. Thank you for joining us. And before we get started, be sure to hit the subscribe button. Go ahead and hit the like button because you're going to love this show. This show is a hot topic, and we've got Mark Dutram from the BayView Private Wealth group here. And man, we are going to talk about investments, how to preserve the wealth that you've made, how to maximize it once you've earned it. You surely don't want to see that investment devalued in time. So we've got some great topics we're going to hit this afternoon. So thank you for joining us. Mark, tell us a little bit about BayView and your background.
I love it. This is a great show. I've been doing this investing and financial planning for about 30 years. And I did it for other firms for a long time. So 2 years ago, I launched BayView Private Wealth in Destin. Again, we were a very large firm. Again, we had over 400 clients, and we just decided, hey, we're gonna service no more than 100 families. That way we can have deep relationships and, again, do estate planning, financial planning, investments, everything for just a select group of families. And we couldn't be happier. I mean, it was one of the best things I've ever done. Yeah,
that is, you mentioned when financial managers, they tend to get big and then they lose focus on working with the individual client. And it's a very personal relationship because people's money and their investments, it's very personal to them and they want to make sure they're taken care of. So I applaud you for doing that and putting the emphasis on quality service to the client. So that you got that for free. I wasn't trying to do a sales pitch for BayView, but that is so important because being a CPA, I work with a lot of clients, and I don't do financial management or financial investments, but I see how that works, and I've seen people that do that really well and those that don't do it so well. So that's very good that you do that. And let's
yeah, it's a business model. You could we call it a lifestyle practice, so it is better for everyone. Again, the clients love it because we can be fully engaged in them. Again, we love it because, again, we have more time to actually even focus on continuing education and making ourselves better at all the different disciplines that we need to do.
Exactly. And like any other profession, it takes study time. You have to stay up on the markets. You have to stay up on technology changes. And we're going to hit on some technology that you use in your practice today. So that'll be near the end of the show, but I think it's well worth staying around for.
I love that.
Good. Let's get started with some slides. We got some good slides and efficient markets hypothesis. So what does that mean? I mean, that's not something that you created. That's not a terminology that you or I created, but that's been around for a while.
I know, and not one that's used in everyday language, right? You don't pull that out at a party or something like that and say, hey, let's talk about efficient market. No, I guess in its simplest terms is it means that all of the data is already reflected in stock prices. So, again, there's probably, I think, $600 billion change hands every day.
Wow.
In the stock market. So all the buyers and sellers, it's almost like when you're betting, how it puts equal people on both sides of the trade.
Right.
So stocks then are already efficiently priced with all of the collective data. You go into the market with a lot of research. I go into the market with a lot of research. I think that Apple's going to go up. You think that Apple's going to go down. And so the market, through all that efficiency, prices itself very effectively, very efficiently. And that's kind of basically what that means.
Yeah. Interesting. So, a lot of people that they're not working with an advisor like you, they're investors, and I won't call them armchair quarterbacks, but they do their own investing, and they a lot of times end up chasing the market, or they chase last year's winners. And I've seen some statistics on last year's winners that are winners in the current year is like 20 something. It's a real low percentage.
I mean, and so like I said, I've been doing this for 30 years. I fell prey to that for probably the first 20 years. I'm an optimist. You could probably know that from hanging around me for any period of time, but yes, I would say that I could, with a crystal ball and with, again, the pros. So even, like you said, money managers, mutual funds, ETFs, those guys, their ability to add what's called alpha beat their benchmarks.
Right.
Very low percentage. And so as a matter of fact, if I hire one looking in the rearview mirror that's done well in the past, his likelihood of exceeding that and doing it again is even further decreased.
Wow.
So there's professional advisors out there that are doing the same thing. They're buying people based on past performance only to have you. So I didn't get to benefit from that, right? The performance they experienced was in the past.
Right.
I buy them now, and then subsequently they underperform. And yeah, I mean, that's not a good recipe for my money nor your money.
Right.
Yeah.
So the better model is to have some index or some formula driven allocation of your money, and not to give away the juice that's going to come at the end, but that's really where we're driving to, right?
No, yeah. Well, so we tell people, and again, I teach people that if you don't know what you're doing, the best thing you could do would be indexing, right? Because now you just buy the market and you remove the things from the market that can steal returns. So wrong guessing,
right?
Turnover, higher taxes, additional costs, right? So those things would be eliminated in a index type of performance. And then, like I said, what we do is we make the indexes smart. So we add some what we call factors to our portfolio.
So don't try to outguess the market, and that kind of goes with chasing what's happened in the past. Don't try to guess it. If you're not even some of the professionals, I guess there's some of those that even guess as well, or they chase last year's winners.
Yeah, like you said, historically you'll have maybe 20% of what we call active managers, the guys that are trying to outwit the market with security selection and timing the market. Their likelihood of winning, again, is very low. And so even the ones that do win, you would say, hey, let's follow those guys around. Their likelihood of repeating it. So I always say, too, if somebody comes to me with a manager that's done well, I would say, show me how that's not luck.
Right.
Show me how they could repeat that process going forward. And most of the time, again, they're not going to be able to.
You know, we were talking about this before we started recording, but there's a lot of focus right now on the government putting money into the economy. I mean, we've seen just in 2021, there's the $1.9 trillion they call a stimulus plan for the COVID-19 that went into the market in January or February. There's discussion of this infrastructure plan that's going to be who knows what's going to happen with that, but that's a price tag of another $2 trillion that they're looking at going into the economy. And what happened in 21 to try to offset what happened with COVID. So all that money going into the economy, surely that's having an effect on the dollar. The valuation of the dollar has to be decreasing with all that happening.
Yeah, no question. So we would actually be bullish for 2021 because what's happening is we're moving those returns forward, right? Mm-hmm. So a lot of that, you've got, again, pent-up demand. You've got historically low interest rates. You have, again, all of these stimulus dollars coming into the market. Well, that is actually going to produce market returns, right?
Right.
So, performance of companies, which, again, have been quite solid, but, is it sustainable? So I think, a lot of where you end up has a lot to do with where you start out.
Right.
And so, prices today, we know of stocks can be quite frothy in certain sectors for sure. So I think returns are going to be a lot more humbling moving 2022 and beyond because of what you just talked about. Eventually, those things have to be paid for, right? So probably taxes are going up in the future. Probably a regulatory environment that's going to be a little bit more strict. High multiples that you're paying for securities. All of those things are going to produce again, headwinds for market returns,
right?
And beyond. So
great
point.
Yeah, that's some of the timing that I've seen. Also, is that 21 looks to be strong, but then those things, all that spending, kind of catches up at Q4 of 21, and then 22.
Think about even our own personal budget. If we were to do that, just go on a binge of just spending, eventually, you're going to have to tighten the belt up and, again, slow down growth, slow down spending, slow down. The U.S. economy, 70% of GDP is consumer spending, right?
Right.
And if you start removing all those stimulus checks and things that are going out there.
Oh, yeah.
But, so we say focus on the things that you can control, which would be reducing costs, reducing taxes, reducing wrong guessing, reducing turnover, and then capitalism works, right? I mean,
right.
Let it work. We're a free market, conservatives, and that's why, again, we're not too much on government intervention,
right.
but
right.
They're definitely participating right now. That's for sure.
Yeah, that we've had an economist on several times, and when we see that when the government intervenes in the economy and the free markets, it really has a negative impact. And we go back to we've used the cash for clunkers as an example of that, and the unintended consequences that happened in the market. So,
it's funny because we're modeling, we use scenario analysis, but during the Obama administration, again, trillions of dollars were infused in the market at the time, and no effect.
Right.
GDP growth was still stagnant, still low. We had, again, a good decade of underperformance.
Right.
And so it didn't work, right? It didn't work in stimulating the economy.
Right. So focus on what you can control. So we talked about the controlling your taxes. You'd mentioned some other things there. So what else can the investor do? And I'm sure that you're going to say that the sooner you incorporate a plan and you start investing, the better you are, because time is a big component of the plan that's put in place.
Yeah, I mean, people don't plan to fail; they fail to plan, as we always say. So obviously, I always say, work with an advisor, especially if you don't like doing this kind of stuff, and be holistic. So they're looking at the tax consequences of your investing. We see that, people kind of mismanaging, having the right assets in the right accounts, having the right accounts. And then again, removing all of the stuff that's going to steal returns. We know taxes steal on average 1% to 2% of people's returns over time. That's a lot of money.
That's a lot of money.
Right? When you start amplifying that times year after year after year.
Yeah, and actually, I was listening to somebody today, which this is what's the biggest cost in your household is taxes.
Yeah.
So
and about to go up.
Exactly. So that's
we're
not hoping that happens. It's just inevitable that's going to happen. There's already been discussion from the executive branch that we have now. So that is going to happen. They gave us money, now they're going to take it back. So what someone giveth, they can take it away.
That's true. So again, businesses, you and I, the consumer, we're what creates an economy.
Right.
And again, the more freedom we have to do that, to kind of expand, the better off we'll be. Right?
Absolutely.
And not run and intervention and the whole crowding out effect. Yeah.
We don't need the government picking winners and losers. Let the market do that.
Exactly.
So I know that if we go to the next slide, we've talked about don't chase the winners from the past, because those are going to be different in what we're looking at now.
Yep.
So let's go, John. Let's go to the slide with the dimensions of expected returns.
Yep. So this is really important as we talked about making the index smart, right? So basically, what we do is we say, the benefit of indexing is very low cost, right? And then again, participating in a market, capitalism is quite well, depending on the time frame you look at. The stock market, S&P 500, by the way, would produce about 8 to 10% a year, right? But also the negatives of that is you end up buying bad companies just because they're part of the index, right?
That's right.
And then you also get what's called the full market beta. Last year when the S&P was down 34% or whatever, you were down 34%, right?
Yeah.
So what we do is we take that index and then we say, how about we make it smart? How about we start taking out all the companies that are overvalued, right? As we said, that you paid too much for.
Right.
So that's one of the factors that we use in our models. How about we start stripping out the companies that are less profitable, right? So let's choose the ones that have higher margins, higher quality of earnings.
Better cash flows,
right. Yes. Better balance sheets, lower leverage, right? And then, so if we start stripping those out, and then size, it would make sense to me anyway, intuitively, that a smaller company should outperform a larger company over time, right? Because you're taking more risk, right, in that. And so, this slide is actually showing that actually comes to pass over time. Where there's risk is opportunity. And so as you take more risk, you're going to be compensated for that, and that's capitalism. That's how it works. And so what this slide is showing you, that over every 5-year period, and by the way, this is 100 years worth of data. Actually, this one I think is showing what's called bootstrapping. It has 20,000 random monthly returns of bootstrapping, right? Mm-hmm. And it's saying that over a 5-year period, 65% of the time, right, that if you have a size tilt to your portfolio, it's going to outperform the broad benchmark.
Interesting.
Yeah, which is actually pretty good. So not, 100% of the time, but if I said, hey, 2/3 of the time we're going to win.
It's better than a 50-50 toss-up.
You got it right there,
Yeah.
right?
So so what that is telling us is the smaller companies have more upside.
Would you rather bought Apple when it was small or when it was large?
Small.
Exactly.
Right.
Microsoft when it was small.
Right.
So what's happening there is you're buying them and able to participate in that type of rapid growth. As they get bigger, I mean, their growth is going to obviously become smaller.
So that's almost common sense also, that once a company, and you can look at it in your own investments too, once it reaches a certain size, you've kind of squeezed out all of the profit on that.
Well, and so what do they do to attract you to buy their stock, as a matter of fact? They say, hey, my growth is not going to be as strong. Let me pay you a dividend.
Right.
I'm going to start giving you a rate of return in the form of an income cash flow.
So in that example, you're trading the growth with cash flow.
You got it.
Okay.
So the company has a choice on what it does with its money.
Right.
Either it can fully invest in itself to grow, or it can pay you as an investor. Right. And we would want it to grow, especially if it's a good business model. This one is a value tilt, and probably some of the most famous, again, a Eugene Fama, a Kenneth French, a Warren Buffett. Warren Buffett's probably one of the most famous value investors out there.
Right.
He says that whatever you invest in, price matters. And I would say that not only applies to stocks, but that applies to anything. Look at real estate.
Absolutely.
Look at gold. Look at Bitcoin. Look
Right.
at anything. When you buy it, if you pay too much for it, you're more likely to get hurt. So what we do by making the index smart is we say, what if we carve out these securities that are intrinsically overvalued from where they historically trade? And what this is showing, again, is we're getting that same 2/3% of the time that if you incorporate just this one factor, just this one tilt, they're going to beat, again, broad markets, broad benchmarks. And again, we show people this. Yeah.
So the value tilt also is that let's focus on those that are not overpriced. Let's go to the tried and true buy low, sell high.
Yes, sir. Well, and a lot of people, if you had two funds, and people confuse this, but you could buy a growth fund or a value fund.
Right. True.
Remember, the growth fund, he doesn't care about price.
Right.
He's buying a sector, a momentum, some type of trade that's actually happening. He doesn't care. The value guy says, yes, price matters to me, and so I'm not going to overpay for security, and that's what we tell our clients. We don't want to overpay for securities in the portfolio.
So what we're doing right now, we're going through the different components of building this index.
You got it.
Okay.
Well, or making the index smart.
Okay.
Yeah.
And we're going to use technology to do this. I mean,
that's
this got so much data in it that I could see a bunch of accountants in their green eye shade. It would take them forever to create this.
Well, so algorithms, right?
Yeah.
And matter of fact, you could think then over the past year, sectors that became inexpensive, hospitality, retail, those kind of things, because
Airline.
they were oversold, right?
Yeah.
Global real estate, municipal bonds. Yes, there was a lot of things that actually got oversold. So price matters, and I would contest, yes, in a huge way that matters over time. The next one would be profitability. We kind of talked about it a little bit, but and again, if you looked at two companies that made 10% last year, how would you know then what's the best one to pick? Well, then you start going to, like you said, the income statement and the balance sheet.
Right.
Which one looks more attractive from a margin standpoint, from a quality of earnings? Are they doing any off balance sheet, kind of thing?
Off balance sheet risk.
And so profitability, actually, there's a shorter period that it covers because remember, people's books were not as open as they.
True.
So you don't have 100 years worth of data, but you've got a pretty long period of data that says if you paid attention to profitability, it is going to reward you, again, almost 90% of the time over a 5-year period.
So is that the last factor that we're going to look at?
Well, we're keeping it at like a 50,000-foot view,
Right.
but we do different things in fixed income. But this is an integrated. So this is saying if you take all three of those, Charles, right, and you incorporate them by making the index smart, this is saying 90% of the time over a 5-year period, you're going to actually beat broad benchmarks. That's powerful.
That is so powerful.
So, I mean, we can't give people 100% of the time guarantee, but I mean, and matter of fact, we have gone through periods recently where this did not prevail, right? And then people would guess, wow, hey, is this still gonna, but now, I mean, it's outperforming in a huge fashion. And of course, we don't have enough time on the show to kind of dig into all the data, but it made me double down.
But here's the important part of that, and we talked about this before the show started, is the time horizon that, people that are near retirement, they don't want to go all in and be and hit the bottom of a market drop and they don't have enough time to recoup. Let's say it's a 20-year. I mean, we're looking at 5 years, not 20.
That's right. Well, that's a great point, because
Yeah.
if you're buying into the market today and you have a very short time horizon,
Right.
and you paid very high prices for the securities, again, through what's called regression analysis, you can tell what your estimated returns are going forward. That's why we said we're much more conservative on, or humble on, the returns going forward, because if you pay a high price now, the probability of you having historically high returns going forward are not good.
Right, that's right.
Yeah, that would make sense.
Right.
So yeah, an integrated approach. Just in the equity side, we do something different in the fixed income side with kind of factor based as well. But yes, we're increasing the likelihood of success, which is the only thing that people care about. Is, hey, give me a higher probability of succeeding
Absolutely.
in investing.
And that's compared to the broad-based indexes.
That's right. Well, the indexes that these guys are up against, right? So yeah, if you're just equities as a whole, is a growth guy beating a value guy? Is a large guy beating a small guy? Is a less profitable? Yes, sir. Yeah.
That's very interesting. So when you're planning with an individual, you go through this. Where does risk tolerance come into that?
Absolutely. So, we have probably 10 to 12 different models. Some goal-based, some age-based, some risk tolerance-based. People have to be able to understand what they own, right? Otherwise, you can't own it, right? If you're not. And then, like I said, we hope you actually get the philosophy, because then even during those periods, those 10% of the times where it's not working, you still have the conviction.
Right.
Because you go, hey, wait a minute, I know this works over the long term.
Right.
So even if I have a period of underperformance, what this chart is showing, trailing 12 months, right? You see that small cap value. So Charles, that's what I'm saying. That small box there that you see on the bottom left, right?
Right.
Should be the best performing box over time. Because number one, it has all of the factors kind of built into it.
Right.
That one it doesn't have the profitability tilt, but it has the size and the value tilt, right? And so it's up 114%.
Wow.
Versus, large cap growth, which again has done.
And that's 1 year.
That's right. These are still great numbers. They're still crazy to me when I look at that during a COVID. COVID was a part of that.
So here's if you had the crystal ball, and maybe you did this, that when the market during COVID in March, when the market tanked,
yes,
if you were sitting on cash when that happened and you just went all in.
We did it. So actually, like I said, I even overweighted to that small cap category because it was already underperforming going into COVID, right? We were already seeing a historical discrepancy between that large cap growth, small cap value space. So, and like I said, from that bottom, again, it's up 114%, which is quite staggering. What's important, though, is you might look at that then and say, that's got to be expensive now. Right. So you say, hey, it's up 114%.
Yeah, that's the fear now. Are we at the top of the market?
Okay, so I think the next slide will show. This is interesting, right? So this is forward PE. Everybody remember, when you're buying a stock, you're buying $1 of future earnings, and you're paying a price for every $1 of future earnings. So what this is saying is, if you look at bottom right-hand corner, small cap growth.
Right.
That's saying you're paying 87 times $1 of future earnings, which would be historically very expensive, right?
Right.
Matter of fact, the market as a whole, the S&P 500, on average trades at around 16 or 17 times earnings is what you're paying as a fair value for that. So large cap growth, you're paying still 30 times $1 of future earnings. But look at small cap value. Even after being up 114% trailing 12 months, you're still paying 19 times $1 of future earnings. And it's they're still attractively, and that whole value
attractive.
section.
It's certainly attractive compared to the growth.
You got it.
Wow.
Yeah. So again, if we're still looking at things today where we said, hey, price matters, what would I be owning? Yeah, our portfolios, we feel like we still have very attractive price security.
But the way that would work in real life is that if you have an investor now that they're going into the market, you're going to focus on the 19.33 block.
Well,
is that right?
Yes. Well, yeah, because remember, that's incorporating our factors in there.
Right.
Yeah. So, but we always do that.
Okay.
Right. I mean, that's always important. What's happening today is you see a lot of people crowding into that top right box, the small or large cap growth, because technology is sexy, right? Apple's sexy, Nvidia. I mean, all these companies that have been, the NASDAQ, huge returns, right? But there's a rosy, what do we say, a high price for a rosy consensus?
Right.
Yes, and so consequently, year to date, yeah, you see tech pricing itself a lot, again, a lot lower than what some of the other sectors are. And I think because you're seeing, as we talked about, interest rates rise, it starts to pull some of the multiples that you actually see in the market. If I would have showed you that, again, probably a month ago, it was even higher. Large cap growth was even frothier at 30, 34, 35 times a dollar future earning. Yeah.
Interesting. You're gaining a fan of this index process that you go through.
It works.
What's the next slide we have, John? So this is a result of putting all that together. Is that right? I know that's hard for the viewer to see that.
Yeah, well, this one is kind of just showing. So, Charles, if you came to me and said, like you said, you're a couple, I'm very close to retirement. I want to draw, $5,000 a month, $10,000 a month, whatever it is from my portfolio. Could I sustain that? What's my likelihood of sustaining that through a retirement? So we use, again, very sophisticated software that we could run various scenarios on, either macro environments that are happening or government intervention versus just market performance.
Right.
And we say, based on that distribution rate, how do we need to build this portfolio to give you the greatest probability of success? So the same thing in building the portfolios is, the distribution strategies that we do.
Interesting.
Yep.
Man, I'm seeing a lot of value in this this plan. So I think we have one more slide. And now this is really hard to see, and I would say the gold line that goes like this, that's your money on a properly planned allocation and investment strategy.
Actually, what that would is showing, I forgot we had this slide. It's showing the S&P 500 is that bottom blue line.
Yeah.
Versus the value component, adding the factors
so I was right.
to it.
That is what it's showing.
That is exactly what it's showing. But the whole purpose of that is actually we're looking at correlations and again, max drawdown risk scenarios. The same thing if we looked at two funds that made 10%, the next thing we go underneath is what we call standard deviation and alpha, beta, trend, all these different kind of risk metrics to make sure that these things are actually benefiting the sum is greater than the parts. Yeah, right. Synergy. Yeah.
Man, this is some very good stuff, and I know this has been so beneficial to the viewer. So thank you for joining us. Mark, we're going to wrap it up there. Mark Dutram from BayView Private Wealth. Man, this has been a great show. I look forward to seeing you on a future show. I know we've got 2 more scheduled, and they're going to be equally as impactful. So, audience, please tune in for future shows. Mark Dutram with BayView Private Wealth. What a great show. You've been watching Answers That